Listen, the reason institutions laugh at your VWAP strategy is because they aren't using it to find signals. They're using it to hide their footprints. Welcome to this explainer. Today, we're moving way beyond that generic retail trading advice you see everywhere. We're going to look at exactly how billion-dollar quantitative firms actually view market data, and why the tools you might be relying on right now are being used in a completely different universe by the pros. To really grasp this, we first need to talk about what's known as the noise area. See, while retail traders are zooming in on every single tick, desperately trying to read the tea leaves of a chart, institutions operate with a completely different assumption. They assume that within a certain range, price movement is literally just random. It's pure noise. But there is an exact threshold that breaks this equilibrium. And today, I'm going to reveal what that threshold is and exactly how the big players spot it. Okay, let's dive right in. The insights in this explainer aren't just some abstract theory. This is based on the learned and earned experience of analyzing thousands of institutional order blocks. I've seen how these algorithms operate from the inside, and I can tell you for sure, the gap between how a home trader views an indicator and how an institutional quant views it, it's staggering. To put it in perspective, the generic retail reality is sitting around waiting for a simple moving average crossover on a chart, just hoping it means buy. But the institutional reality, quants are taking time series data, computing complex math transforms like volatility ratios or volume z-scores, and feeding those statistical inputs directly into machine learning pipelines. So it's not about visual patterns at all. It's entirely about the math. Section 1. The Institutional Indicator Truth. So let's look at our first major concept here. Institutions categorize their indicators into what they actually call an indicator zoo. And it's all based on the specific math they want to capture. They look at order imbalance to check if the limit order book is too heavy on one side. They look at trade autocorrelation to detect when a massive client order is being sliced up into tiny algorithmic pieces. They hunt for volume clustering to find spikes that act as leading indicators. And they use relative value to see if an asset has just drifted way too far from its sector family. It is a highly specialized toolkit. Section 2. Hiding footprints with VBOG. All right, now let's shift focus to perhaps the single most misunderstood indicator in all of retail trading, VWAP, or volume-weighted average price. Retail traders often treat this as some sort of magical support or resistance line, but institutions, they just use it as an execution benchmark. When a firm needs to move hundreds of millions of dollars, they absolutely cannot enter that trade all at once or it'll completely break the asset's price. So they use VWAP to discreetly slide massive amounts of money into the market without moving it against themselves. So the crucial point to remember here is execution versus prediction. A human trader might try to predict the bottom to, buy low, but an institutional algorithm has a much simpler mathematical mandate. Just buy better than the VWAP. If their execution algo can accumulate a massive position at a place that is mathematically below the day's average volume-weighted price, they've done their job perfectly. That's considered a massive win for their client. Okay, so if the algorithm is just happily accumulating below VWAP, it seems like a flawless system, right? Well, actually, even an institutional algorithm will abruptly halt an execution strategy and stop buying entirely if it detects one specific terrifying thing in the data. So, what exactly is it? Section 3. Detecting toxic order flow. Let's pull back the curtain on the hidden mechanics of institutional risk management. To explain this simply, like we're 5 years old, institutions are absolutely terrified of selling to someone who knows a secret they don't. In the finance world, this is called adverse selection. And to monitor this, they use a specialized indicator called VPIN, or Volume Synchronized Probability of Informed Trading. Essentially, it measures order flow toxicity, which is the danger that smart money with inside information is currently overwhelming the normal market makers. The consequence of this is actually fascinating. When retail traders see a sudden drop in price, they usually scream, buy the dip. But when an institutional algorithm sees a sudden spike in the VPIN indicator, it does the exact opposite. It realizes the order flow is toxic, and the risk of a flash crash or a total liquidity collapse is imminent. The algorithm does not buy the dip. It exits the market completely. Section 4. Machine learning and meta-labeling. So we have all these incredibly complex indicators being processed, VPIN, volume z-scores, order imbalances. But I promise you, there isn't some exhausted human trader staring at 50 monitors calculating this on the fly. This brings us to meta-labeling. Think of this as basically checking the checker. In modern quant firms, you might have a primary-based strategy that spits out a simple buy or sell signal, but that signal is never blindly executed. A secondary machine learning model, the meta-labeling model, evaluates that signal against all those complex statistical inputs from the indicator zoo just to decide the actual position size. Let's look at the power of the secondary model in action. Say the primary model is screaming, buy, but the secondary meta-labeling model looks at the order flow, calculates a low probability of profit based on the current stats, and steps in to intervene. Instead of taking the full position, the algorithm might only buy 10% of its usual size and hold back 90% of the capital. That is risk management on a level that basic chart reading just can't match. Section 5. Hunting for market regimes. Now, this is the overarching concept that ties all of these fragmented indicators and machine learning models together. Remember the noise area we talked about at the very beginning? Well, here is how quants mathematically define it. They often analyze high-frequency data in 5-minute windows just to establish an equilibrium zone. As long as the price bounces around in that zone, it's just random noise. Buyers and sellers are perfectly balanced, but they patiently wait for a specific indicator, like normalized excess demand, or NED, to cross a mathematical threshold. Once NED breaks out of that equilibrium, the noise stops and the true trend begins. Ultimately, quants are using all of this data to identify the market regime. You can think of the market regime simply as the market's current mood. They use complex statistics called hidden Markov models to estimate the probability that the market is in a bull mood, a bear mood, or a sideways ranging mood. And why does this matter so much? Because a trend-following system that prints money during a bull mood will completely bleed your account dry in a sideways mood. The indicators literally tell the machines which specific trading system to turn on and which to turn off. Which leaves us with this absolute crucial takeaway. Staring at a VWAP line is practically useless if you don't mathematically understand the market regime it's currently operating inside of. If you aren't adjusting your strategy based on the market's mood, you are flying blind. I really hope this explainer has shifted how you view market data. Next time, we'll dive into exactly how you can start building your own hidden Markov models to identify these regimes yourself. Until then, keep questioning your inputs and stay focused.